Norway is literally the wealthiest country on the planet. In 2023, Norway's Norges Bank Investment Management, NBIM, which manages assets totaling 1,379 billion US dollars, topped the list of the world's wealthiest sovereign funds. Following closely behind are two Chinese funds with 1.2 and 1 trillion US dollars under management, respectively. The fund, powered by Norway's oil and gas revenues, delivered an impressive 6.3% return in the first 3 months of the year, resulting in a 107 billion US dollars gain. This brought the fund's total value to a staggering 17.7 trillion kroner, about $1.6 trillion by the end of March, translating to almost 291,000 US dollars for each of Norway's 5.5 million inhabitants. Amazing, right? But how did a country with only 5.5 million people become so astronomically rich? The answer to this question is pretty straightforward at one glance, but it is not as simple as it may seem. Yes, the lion's share of the Norwegian wealth is due to oil and gas production. But if you look at the top oil and gas producer countries, you won't see Norway among the top 5 oil and gas producer giant states like the US, Russia, Saudi Arabia, China, or Iran. Besides, for instance, in terms of oil reserves, Venezuela, Iraq, Libya, and Angola are much richer than Norway. Still, unlike them, Norway is a leading country by GDP per capita, with over 1,000 US dollars per citizen. So, what is the Norwegian secret to wealth? First, we need to briefly dive into history. In the period leading up to 1917, there was a notable alignment in the creation of value among the 3 Scandinavian countries of Denmark, Sweden, and Norway. However, their economic trajectories diverged during the interwar years. Subsequently, from 1945 to 1975, a period of convergence occurred. Following this, the discovery of oil and gas led Norway to experience positive divergence from the other 2 countries. Over the 1820-2019 period, the annual compound growth rates for the 3 economies were 1.63% for Denmark, 1.86% for Norway, and 1.83% for Sweden. After the German capitulation on May 7, 1945, Norway faced the challenge of reconstructing its economy and re-establishing political and economic order. The political decisions made during this time, such as the establishment of a social democratic rule and acceptance of the Marshall Aid Program, played a significant role in shaping Norway's economic growth. The country joined various international organizations, including NATO, the UN, and EFTA. The period from 1950 to 1973 is often called the golden era of the Norwegian economy, characterized by annual GDP per capita growth of 3.5%. The Nordic model provided social security and evenly distributed wealth, but did not result in very high economic growth. However, in the coming decade, Norway successfully adapted to globalization. Norway has twice rejected EU membership, but emphasizes liberal foreign trade. The country's economy has grown significantly due to high oil and gas prices, while also becoming dependent on petroleum revenues. The Norwegian government pension fund Global, established in 1990, invests oil and gas revenues abroad, with a portion available for domestic use. The dot-com bubble and subsequent crash affected Norway's stock market, and the country followed the international business cycle. In the 1990s and early 2000s, Western countries adopted inflation targeting in their monetary policy, leading to falling inflation rates and reduced key interest rates. What we have effectively seen is that Norway managed to escape both the resource curse and the Dutch disease. The resource curse and the Dutch disease stem from resource riches, but manifest in different ways. The resource curse refers to the tendency for resource-rich countries to experience slower economic growth than similar countries without significant resources. The Dutch disease, conversely, describes the rapid decline of the non-resource traded goods sector due to resource exports. The Dutch disease is a phenomenon that is closely connected to 3 main effects: the factor movement effect, the spending effect, and the spillover loss effect. The factor movement effect involves the transfer of production factors such as capital and labor from other industries to the extraction of natural resources. The spending effect is related to the increase in overall demand resulting from the income generated by resource exports, which can lead to periods of excessive demand within the economy if the income is converted into domestic currency. Lastly, the spillover loss effect refers to the negative impact on other sectors of the economy due to the loss of positive externalities associated with non-resource traded goods. So, here's the answer to why Norway became so rich. Norway masterfully navigated the challenges of resource dependency, blending luck with strategic policy. As early as the 1970s, Norwegian policymakers foresaw the potential pitfalls of resource dependency and took deliberate action to mitigate these risks. Here's a captivating look at their innovative strategies. Firstly, by centralizing wage formation, Norway aligned wage increases with productivity gains in manufacturing. Initiatives like the Solidarity Alternative balanced income and softened oil's impact on non-oil traded goods. Secondly, by exercising fiscal prudence, Norway paid off debts and created an overseas petroleum fund. This move shielded the economy from excess demand and real appreciation, protecting competitiveness. When not at total capacity, they allowed controlled demand increases while keeping a close eye on public spending. The forecast for Norway shows a continuous decrease in the ratio of national debt to gross domestic product from 2024 to 2029, with a total reduction of 7.9 percentage points. After 6 consecutive years of decrease, the ratio is expected to reach a new minimum of a little over 30% in 2029. Then, Norway cultivated domestic expertise in offshore oil extraction, built cutting-edge technological centers, educated oil specialists, and invested in oil research, ensuring a diverse export base. Oil and gas companies operating in Norway plan to invest 240 billion Norwegian kroner, almost 22 billion US dollars, in 2024, an increase from 220.5 billion kroner in 2023, and higher than previously anticipated. Fourth, resources were channeled into education, research, and development. Scholarships for international study increased teaching and research hours, and the establishment of centers of excellence were crucial components. On average, OECD countries spent 5.1% of their gross domestic product, GDP, on primary to tertiary educational institutions in 2020. In Norway, this share was 6.8% of GDP. Fifth, by leveraging the political legitimacy of resource rents, Norway effectively countered recessions. Returns from the petroleum fund were utilized for active governmental capacity, outperforming other financing options. Unsurprisingly, Norway's economy experienced rapid growth in January, surpassing expectations and indicating resilience to increased living costs due to its significant fossil fuel reserves. Moreover, a centralized wage negotiation system was maintained. Employers and unions were encouraged to consider the broader economy. A neutral agency sets wage increase ceilings based on productivity. Female participation in the labor market was stimulated, and labor market information coordination was enhanced through vacancy and competence agencies. Lastly, Norway has consistently developed and gathered expertise in various industrial sectors, diversifying its exports. The country aims to identify and pursue successful long-term strategies to maintain its comparative advantage. It strongly focuses on advancing knowledge, technology, and human capital. Equinor, a Norwegian energy giant, has emerged as Europe's primary gas supplier, surpassing Russia. This shift occurred after the European Union imposed sanctions on Russian gas imports following Russia's invasion of Ukraine. Equinor's annual $6 billion US dollar investment represents the maximum amount the company can allocate without compromising returns from its operations in an area where it has been active for over 50 years. Thus, Norway's proactive and innovative policies have been pivotal in navigating the complexities of resource dependency, securing economic stability, and fostering growth. However, despite the importance of the oil and gas sectors, Norway is working on decreasing its dependence on fossil fuels. On April 23rd, NIB and its board hosted a seminar in Oslo for clients, investors, and stakeholders to discuss Norway's green transition by 2050. Norway aims for a 90–95% cut in emissions by 2050, targeting a 55% reduction by 2030. In this regard, Norway is poised to have more electric cars than petrol vehicles on its roads by the end of this year or early 2025, a milestone unprecedented for any country. This shift is driven by substantial incentives, which are partly made possible by Norway's significant oil and gas wealth. As of March 15th, electric vehicles comprised 24.3% of Norway's 2.9 million cars, while petrol vehicles accounted for 26.9%. According to data from the Norwegian Public Roads Administration, this equated to a lead of nearly 76,000 for petrol cars, significantly lower than the 104,590 new electric vehicles sold in Norway last year. In the end, only time will show how resilient Norway's wealth is. Still, for now, it is undeniable that this small oil and gas-rich nation has succeeded in its endeavor to prosper and avoid all the curses following fossil fuel abundance that many countries fail to do. Thank you for watching. If you enjoyed the video, hit the like button and feel free to share your opinion on the topic in the comments section below.